Ever find yourself staring at your investment options, feeling kind of paralyzed by choice? Yeah, you are not alone. Today, we're going to cut through all that noise and solve one of the biggest dilemmas for any modern investor.
It's the classic question, right? The big showdown, mutual fund versus ETF. Which one's going to grow your wealth faster? Which one gives you the flexibility you actually need? It seems complicated, but I promise you, it's way simpler than you think. And here's my promise to you. By the time we're done here, you will have that aha moment. You'll have the clarity to choose the right path for your money. So let's dive right in. All right, first things first, let's get to know our two contenders. Think of this as the pre-match weigh-in, where we size up the competitors before they go head-to-head in the ring. So on one side, we have the mutual fund. The whole idea here is pooling resources. Just imagine a bunch of people putting their money into one giant pot. Then a professional fund manager takes that pot and invests it for everyone across a ton of different assets. You invest, and they do all the heavy lifting.
So what are the key things you need to know? Well, first, you've got a pro at the helm, a fund manager calling the shots. Second, and this is a really big one, it's priced only once a day. That price is called its net asset value, or NAV. This structure makes it absolutely perfect for automated long-term strategies, like those systematic investment plans.
And in the other corner, we've got the exchange-traded fund, or ETF. Now, the easiest way to think about an ETF is that it's like a mutual fund that got a high-speed stock market makeover. It bundles a bunch of assets together, sure, but it trades on an exchange all day long, just like a share of Apple or Google.
Okay, so what does that actually mean for you as an investor? Well, it all comes down to flexibility and real-time action. Because ETFs trade like stocks, their prices are constantly jumping around during market hours. And unlike most mutual funds, they're typically passively managed, which just means they're built to mirror a specific index, like the S&P 500. All right, introductions are over. We know the players. Now it is time for the main event. Let's put them side by side and really see how they stack up on the features that matter most.
Look, if you remember just one thing from this entire breakdown, please make it this. A mutual fund's price, it's set once at the end of the day. An ETF's price, it's live, changing from second to second while the market's open. This is the fundamental difference that drives absolutely everything else.
Let's really break these trade-offs down. Mutual funds are usually actively managed. Someone's trying to beat the market, which means the fees or expense ratios can be a bit higher. ETFs, on the other hand, are mostly passive, which helps keep those costs way down. For liquidity, you can sell a mutual fund whenever, but you'll get that day's closing price. With an ETF, boom, you get instant execution at the current price. And that also connects to transparency. With ETFs, you know exactly what you own in real time. So, we've seen all the facts and figures, but now comes the most important part of all, applying this to you. How do you pick your champion based on your own personal investing style? It really boils down to a super simple three-step process. First, you gotta be honest with yourself about your style. Are you a set-it-and-forget-it kind of investor, or do you love being hands-on? Second, what's your goal? Are you looking for automated growth, or do you want real-time control? Your answers are going to point you directly to your champion. If you're hands-off, mutual funds are probably your best friend. If you're hands-on, ETFs are likely your perfect match. This quote really just nails it, doesn't it? It boils the entire decision down to a single clear trade-off. You've got convenience and automation on one side, and flexibility and low cost on the other. And listen, there is no wrong answer here, only the right answer for you.
But hang on a second. We've been talking about this like it's an either-or choice, like you have to pick a side. But what if the smartest strategy isn't about choosing one over the other at all?
Exactly. What if the real pro move here is to stop thinking versus and start thinking and? What if you could actually harness the power of both?
This is what so many savvy investors are doing right now. They're building a solid core, let's say about 70% of their portfolio, with those disciplined, long-term mutual funds for steady, automated growth. Then, they use the other 30% for ETFs to make more tactical, flexible, and super cost-efficient plays in specific areas they're watching.
And when you do this, you are literally getting the best of both worlds. You've got that strong foundation with the professional management of mutual funds giving you stability, but at the same time, you've got the agility to act on new ideas with low-cost, real-time ETFs. It's a powerful combination of stability and agility.
And that really brings us to the final big question for you to think about. Now that you understand the strengths of both, take a hard look at your own strategy. Is your portfolio built for the future, with both the disciplined growth and the flexible control you need to succeed? The answer to that question could be the key to unlocking your biggest financial goals.